The term index fund is synonymous with passive investing, the idea being that for very little cost, investors can park their money in funds that track a specific market. Well, a new op-ed today over the weekend in the New York Times takes aim at the passive nature of index funds, arguing there's a lot of discretion as to what's added in some of these funds. It's written by law professor Stephen Davidoff-Solomon and SEC Commissioner Robert Jackson. The piece highlights something called customizable indexes, which don't track indexes like the S&P, but give the creators more of a say in the stocks that are actually added. More and more asset managers are creating their own indexes and index funds, and by doing so, they can offer funds cheaper because they don't need to pay licensing fees to, say, MSCI or S&P. But they're also adding back an element of stock selection in the process, according to Todd Rosenbluth of CFRA. And the basis of an index fund is to not really have active management, at least in the traditional passive sense. Now, the op-ed goes on to say it's possible that many investors don't actually realize they're getting special indexes. The two point out the need for additional transparency and oversight in these customizable indexes.
So basically, if I see, the something 500 or the something 1000, that doesn't mean it might have nothing to do with the S&P 500.
It might have nothing to do with it. It might have everything to do with it. It's very difficult to really ascertain the difference. And another difficulty here is a lot of asset managers will have previously tracked a certain index.
Oh, geez.
And then they change it over time. And in doing so, make the index fund less expensive. But they also may kind of tweak the stocks that are in it so that it doesn't exactly mirror the S&P 500 and then may outperform or underperform.
But the key thing is that they are still passive. In other words, they're not being actively managed once the initial selections have been made.
They're not being traded per se.
Okay.
But just as any index fund, just as the S&P 500 includes certain stocks and excludes certain stocks over time, these index funds can do the same thing. It's not traded like you would see a hedge fund or an actively managed mutual fund per se, but there is certainly discretion over time as to what goes in and out of it.